good day everyone. We are the Group 5 and we are going to discuss about stock cycle and the four distinct stages of stock cycle, which is the accumulation, markup, distribution, and markdown. So a stock cycle is a typical evolution of a stock's price from an early uptrend to price high through to a downtrend and a price low. So Richard Wyckoff, a prominent trader and a pioneer in the technical analysis, developed a buy and sell stock cycle that occurs over four distinct stages.
So understanding the phases of the stock cycle, the phase 1 is all about accumulation, in which supply in the side of the seller is equal to the demand in the side of the buyers. The first phase of stock cycle is accumulation. This phase usually follows a stock's decline or a markdown phase. Accumulation occurs when interest starts building in a stock and buying of volume comes in. Although buying interest is increasing at this point, the stock is still in a neutral trading phase, in which neither the bulls or the bears can overpower each other. So during this period, a stock will trade sideways within a range of confirmed support and resistance levels. So what is support and resistance? Support and resistance are price levels that the underlying stock or any financial trading instrument can break through or exceed after multiple attempts. A support level is a price level that a stock can seem to fall under due to the oversupply of the buyers. A resistance level is a price level that the stock fails to rise through due to the oversupply of the sellers. Eventually, when a resistance level does break, it will often turn into a support level. When a support level eventually breaks, it can turn into a resistance level. Being aware of support and resistance level are key factors that can determine the effectiveness and success of trades. So when identifying stocks in accumulation phase, the goal isn't to trade them within that range. Instead, traders should be prepared to place a trade as a stock enters its markup phase.
After the first phase, which is the accumulation phase, the cycle moves into the second phase, which is also known as the markup phase. So during this phase, price breaks out of range and begins a sustained uptrend. A sequence of higher pivot highs and higher pivot lows is referred to as an uptrend. Price action can go from neutral to trending at this point. After a price breakout, higher highs and higher lows can be a telling sign that the markup stage has started. In this stage, additional traders and investors develop confidence that they lack in the earlier stage. Seeing the rise in price further increase its demands, which results to continuous market recovery. This is the most profitable time to own the stock and an opportunity to let your profits run. The earlier you can recognize this stage, the more you can profit. The majority of growth and value investing methods perform well during this time.
Good day everyone, I am Venus Baguio and I am the one to explain the distribution phase of the four stock cycles. So distribution, it is the third phase of the market cycle wherein traders start selling securities. It begins as the markup ends and price enters another range of period. The market sentiment goes from being bullish to mixed. It is the period at the end of which the market changes distribution. So when we say distribution, it oftentimes a stock volume will be higher in this phase as the bulls and bear battle it out. Unlike the markup phase, the distribution phase does not provide as many trading opportunities. Yes, there is a higher volume. However, the stock will be range-bound as indecision controls the market, and this indecision may cause an increase in selling as institutions recognize the end of the markup phase and retail traders becomes less interested in the stock.
Good day, my name is Lalen Maydi Guzman and I will be the one who will discuss the markdown. So let us all know what is a markdown. So markdown is a business math term that refers to reduction of the original retail sales price in order to increase sales. In other words, it is a process where the price list is permanently changed to a reduced price. Salespersons usually offer commodities at a reduced price so that they can stimulate a commodity's demand. So how does a markdown work? When it comes to the security market, there are two types of prices, the bid prices and ask prices. So for bid prices, in this case, refers to the prices that buyers are offering on securities, while ask prices are prices that the person selling the securities is offering. So to get a bid-ask price, you need to find the difference between the highest and the lowest bidding prices. Note that it is the difference between the dealer's price charges to a retail customer in exchange for security and the inside market price that is referred to as markdown. So markdown in when the difference in price is negative, while markup is when the difference in price is positive. So there are types of markdown. First, a sale or event. So in this type of markdown happens when you place an offer on your sale. For instance, you can have an offer like say, buy 2 get 2 free, which translates to 50% off. So this 50% off is meant to lure customers to buy the commodity, hence increasing your business cash flow. Next is the permanent price change. So this is where the price list of the commodities are permanently changed to a lower price. For instance, let's assume that you have different styles of shoe in 4 colors and selling them at $100 each. So after a period of 2 months, you have managed to sell 2 of the colors, including a few of the 3rd color. So however, when it comes to the 4th color, none has been sold. So now, you find yourself in a situation where the customers are declining to buy the 4th color of shoes at $100. So you are then forced to lower the price so that you can attract the customers to purchase them.